typically measure market valuations on two metrics, price to earnings and price to book. Okay. Now, the problem is that earnings are so depressed versus a normal environment that the price to earnings can be quite misleading. And again, I will take the 04-07 cycle as a comparison. In that cycle, earnings were compounding at 25% for the Nifty and price to earnings were rising. So both the lines were like this. Okay. And that is when you reach the peak in 2008 when the market was trading at over 30 times earnings. The preceding 4 years, earnings had compounded at over 25%. So imagine, margins were at peak levels, corporate profit share in GDP was 7%, and the PE multiple was at peak level. Now contrast that with the situation today. The absolute PE has not reached 30, but it's in the 20s. But the margins for the corporate sector are very depressed. Corporate profit to GDP is down to 2%. Now, just for argument purposes, if you normalize that and made it 7%, that would actually triple earnings from where we are. And if you did that overnight, then it will take your PE multiple down to a third. So is the market really that rich if it's trading at 20 odd times earnings when the earnings are so depressed? The only argument that you can give against mine is that, okay, the earnings potential is not going to be comparable with that previous period and we'll never go back to 7%. And okay, for a moment, I'll accept it, but I think we can still go back to 3.5, 4 in a normal cycle. And given all the policy boosts, I think that's a reasonable expectation. It will still halve the PE multiple, which means that we are not really trading at peak multiples. So this is the picture for somebody who's looking at a 3 to 5 year scenario. I am not actually worried so much about valuations. However, if you look at it on a shorter duration and say take a 6-month view and then compare India with the emerging world, just because India has outperformed as significantly as it has done, it is looking a bit rich. And therefore, our call that maybe on a relative basis, India needs to cool off a bit. And within the market, large caps need to play catch up with small caps. By the way, small cap valuations are now comparable to the peak of 2006-07. And of course, earnings are depressed for small caps, but on a relative basis, even large cap earnings are depressed, not as much as small cap. And therefore, there is a relative trade there. Maybe the Nifty outperforms the small cap index in the next 6 months. And maybe India cools off a bit relative to the emerging world. Maybe China makes a bit of a comeback because China's regulatory restraints seem to be now ebbing at the margin. And maybe China does a little bit of stimulus because growth has slowed down considerably over the past 12 months. And therefore, the relative trade shifts away from India to China. That doesn't mean the market goes down on an absolute basis. That still hinges on what the world does at large. But on a relative basis, it may feel a bit of pressure.